All right, folks, hello and welcome. I am looking forward to this conversation. A real gem right here, Michael Gayed, who this is somebody that we've been looking forward to getting talking with because we just saw his thesis start to play out this last month with the yen carry trade. We're going to dive right on into that. But a quick bit here about Michael. He is a 5 times Dow and Founders Award winning papers. And I'm going back right now and reading some of this stuff. Great work that he's put out there. He has 1 mutual fund, 2 ETFs, 15 years of experience. And I also wanted to mention, Michael, you just lost a bunch of weight too. You are looking fantastic, brother. So maybe we'll have to get some health tips from you as well.
That's part of the virtual background. Nobody actually knows I haven't lost a single pound. This is all just
It's all
avatar.
AI.
It's all AI. It's all NVIDIA.
Appreciate it, Michael. So I'm looking forward to getting started here. So yeah, this last month on August 5th, we start to saw the Japan carry trade unravel. And this is a thesis that you've had for a while, almost a year now. And this is when I started following you. And the thing that you really stuck out to me is your work, your thesis, your conviction in the midst of this market and a bunch of talking head pundits who kind of just go along to get along. Everybody wants to pump it up. And while, times are good, we've had the cheapest interest rates in 5,000 years. I described it as a participation trophy economy. Everybody was winning. Everybody was smart. Everybody was a genius. Now that your Japan carry trade thesis is played out, now everybody's a genius on that. Now, I don't claim to be a genius, but I've been really appreciating your analysis. And so I just want to, start by talking about what just happened this last month and what was the Japan carry trade thesis in simple terms.
Feels like forever ago, doesn't it?
Yeah, it's moving
Like
quickly.
sort of move real quick. Well, it's funny you say that the bit about the pumping, right? I mean, Wall Street primarily is long only, right? Meaning these guys get paid for markets to go higher, right? Whether it's based on their skill or not. And I think a lot of people, unfortunately, think that I'm some perma bear. They also don't quite understand timelines. The whole thing started at the beginning of last year when I said that I thought 2023 would be a melt-up year, but that there was a risk of a credit event towards the end of 2023. And as 2023 began to progress, it became clear to me that the catalyst for that, which didn't take place back then, but may have started to take place now, would be ultimately Japan through this reverse carry trade. I am not a perma bear by any stretch of the imagination. I literally cannot be, because my approach is to be back risk on after dislocation takes place. Having said that, I am biased. I am biased in that I do want to see volatility, because that's the world my own funds, which I know we can touch on later, live in, right? To spark a flight to safety into treasuries for a moment in time where hopefully my mutual fund, my ETFs can hopefully grab some of that relative outperformance. Okay, so the thesis is really very simple, and I didn't think it would happen in the way that it happened. I didn't think that everyone would suddenly be an expert in it. I didn't think it would suddenly go away. I still don't think it's gone. So it shows you how you can get something right, in quotes, but the way it plays out is always the big question. The thesis is very simple. Look, every other central bank has raised rates except one. And the one that hasn't raised rates is the one that has been on the floor for 2 decades, dealing with disinflation, deflation. So you go through this monumental inflation shock post-COVID because of all the silly stimulus that every single government and central bank put into the system, overreacting. Purposefully or not, that's just what happened. Now we had to go through the fastest rate hike cycle in history. Japan, though, didn't respond like everybody else because they've got so much debt and because they're used to having rates at zero. So they never thought it was a risk to have inflation in their own home country. Japan has always wanted inflation, but they want the right inflation. The right inflation means it comes from wages. The problem is what happens when it comes from the wrong places, where it's from a cost push perspective, from a commodity perspective, from an oil perspective. Now, the whole concept of the carry trade is deceptively simple, but really, really powerful. Money is global. Why in the world do you want to borrow rates in the US? Why in the world do you want to borrow rates in Europe when you can get it basically free from Japan or any other part of the world that happens to have nothing rates? Japan is being the most obvious one. So if you want to leverage up and you're a global investor, it's very easy. Go to Japan, borrow from Japan, take that leverage, deploy it somewhere else in the world. You're not paying any interest really on it. Just a source of leverage. That's all it is, at very cheap rates. Now, where it gets to be interesting is how the currency component factors into that. Okay, so to the extent that the yen, Japan's currency, weakens, if you want to borrow money from Japan as a US investor, you actually like when the yen is weakening. Why? Because you're borrowing a set yen amount, but yen has to be paid back, but the yen is weaker, which means when you pay it back, you're actually paying it back with fewer dollars. Right? So you like a weak yen. Actually, you want to leverage up more when the yen is going that direction. Because you're getting not only interest-free effectively, but now you're actually paying less on the principal after the currency conversion. Okay, well then, what happens when the yen reverses? Well, now you as the borrower don't like that because now it takes more dollars to pay off that fixed yen loan, right?
And that's what happened at the start of August is that Japanese yen started to reverse. Well, it was leading up to that.
It was really the first week of July. It's interesting, actually, if you look back on that first week of July, a lot of intermarket dynamics started to happen. The yen bottomed, small caps relative to large caps bottomed, value relative to growth bottomed. There was actually a pretty big cycle, I think, sea change that happened, and it was the same trade because it all coincided with the yen strengthening from that point on. Okay, now I have said repeatedly Japan will panic. And I've said this again since August of last year, right? As I've been a raving lunatic arguing that this is a legitimate risk and people are not paying attention to it. And I still think it's a legitimate risk. The yen depreciating in the way that it was means that for a country that imports all of its oil, they have a real problem because oil is denominated in US dollars. If the yen is weakening against the dollar, now oil priced in yen is going through the roof. The wrong kind of inflation. Right. This is the key. It's the wrong type of it counters all the wage gains. Right now, you have to worry about the cost push side from Japan's end of things. So, Bank of Japan, they cannot control the price of oil, but they can control what oil is priced in yen, which means they had to engineer to some extent the yen rising. Right. But then just to soften the blow of the oil price side of it. But what happens then to the carry traders? Now they're worried about the yen going against them. And that then creates, a global margin call. Now, you had a 48 hours of trading between that Friday on the 4th and the 3rd and then the 5th, right? When the VIX spiked to that 60 level, which looked more like an aberration than anything else. And suddenly everyone and their brother started becoming experts. And suddenly I saw that my X account had like 14 million impressions that day because I've been very loud and obnoxious making this case for a while. And it's like, even I was saying at the time, I bet you they're going to rally the hell out of the market now. Because everyone turned so bearish suddenly. It's like my own contrarian signals, even though I was the one that's saying this reverse carry trade is coming, I myself was saying, no, they're going to rally because everyone now is so bearish. And that's exactly what happened. But in the same way, everyone now seems to think it's over.
Right.
These people, I'm respectfully to all these people that think it's over, I think they're out of their damn mind. You're talking about a cycle shift, which is monumental, where Japan has not raised rates for 2 decades, while every other central bank has had some cost of capital, and now they have to raise rates, while every other central bank is starting to lower. That is a huge monetary cycle mismatch, right?
And they only raised by 25 basis points, which triggered this.
Yeah, it's like, guys, are you kidding me? I mean, so why did the market calm down? Because Japan said, well, you know what? We are not going to raise rates into heightened volatility. But the raising of rates is what caused the volatility. And they're saying they're not done. This is like, and people are thinking that this is over. I don't know, maybe it is. Maybe the whole thing was a nothing burger. I find that hard to believe logically, right? Not because I'm trying to prove that I'm right. It doesn't make sense to me. I think people are just saying it's over because the S&P largely recovered. Small caps, by the way, didn't.
Right. And this is the likes of JP Morgan, which have been saying that it's 75% over, which is very, comical in and of itself because you still can't even really pin down on how big this is. I've been listening to you explain this in other shows. It's really tough to now. What's the number that you would put on this if you had to take a guess on how big the Japan carry trade is?
It's so interesting because you're right. It's very hard to know the number. We know that there's obviously leverage. We also know that it's obfuscated because there's leverage on leverage, just like we're having options on options now.
Yeah.
I mean, it's like the derivations of the derivatives, right, is the problem, which is why it's hard to really know what the true notional value is. Some estimates are 20 trillion, some are 2 trillion. Who the hell knows? I mean, when you're in such a levered system, you don't need something huge to happen. You just need a butterfly or Mothra flapping its wings to create the hurricane, because in a chaotic system, that's how things work, right? So I know a lot of people get fixated on the size. To your point about the 75% of it's unwound, it's like JP Morgan. I joked about this on X, on @Lead Lagerport. Be my guest, trust JP Morgan. The same JP Morgan that said, we hate Bitcoin and now is in the Bitcoin game. Like, give me a break, guys.
Yeah, right. Yeah. And so you've stated here too that part of the trade is the small cap rotation that we saw too. It's all part of the same trade. And this is what I picked up and I've been talking about over the last month too, is I relate this back. My audience loves crypto, and I'm explaining to them, guys, this is all the way from the Japan carry trade taking place over there, all the way to crypto bros betting with 100x leverage. It's all leverage. And I think the best description for this is the global margin call. That's what this is. When we had the cheapest rates in 5,000 years across the board, and then our Fed raised rates at the fastest pace that they've ever done, and then now with this Japan carry trade too. So the central banks have been backed into a corner. It's just, who's in a worse position. Now, you have a quote here, overconfidence leads to leverage. And Japan here was just the spark, but we're leading up to the main event, which you describe as the credit event. Can you explain that?
Yeah, and again, I'm not a perma bear. I'm not a doomer. It just makes sense to me structurally. And you had it for a brief moment in time. What a global margin call looked and felt like, where suddenly, the Nikkei is going through a 1987 style crash. You had an entire stock market, the third largest economy in the world, I think Japan still is, and their market was acting like a shitcoin. A diversified index? And you're going to tell me it's not leverage that causes that? Of course it's leverage. Of course it's a margin call. And it's so funny to me because everyone started getting on that after I've been saying it for a year, and the same people that ridiculed me then started pounding their chest saying they called it when they didn't. And now they're saying it's over. So no, of course it's not. Of course it's not over. The leverage point is really important, okay, in that leverage is what feeds speculation.
Mm-hmm.
It's like, what is one of the key characteristics of a gambler? They're borrowing. Right. They're not using their own capital, right? They're borrowing against their credit card. They're putting their Rolex watch on the table, okay, to ante up. It's like, okay, so leverage is what drives speculation.
I was gonna say we got the Chase Infinite Money glitch that just
blew
up this weekend, right?
Listen, you're big on TikTok. I know that went viral on TikTok, right?
Yep.
So it's like, okay, so and the entire system is built on leverage.
Yeah.
Right? Which you can argue is, one of the arguments for Bitcoin. Okay, fine, I'm down with that. But, leverage also feeds not just equities, not just bonds. It feeds cryptocurrencies. It feeds artwork. It feeds Rolex watches. It feeds everything.
Yep.
Right? Because it pulls forward a trend. Right? So again, I go back to Japan has been an enabler of leverage for a lot of things for a long time. Okay, and there's, I think, still a tremendous amount of complacency around that getting unwound. You don't unwind leverage like that, and you don't have a global margin call that only lasts for 2 days when something that's been ongoing for 2+ decades. Yeah. Just think about it logically, folks. Yeah. Forget about looking at a chart on the S&P and using that as your reason for the narrative shift, right? Because we know narrative follows price. Just think logically. Does anybody really think, after what was a preview, I think it was literally a preview, okay? Yeah. I really think that that's over just because of 2 days, 2 trading days, and the S&P coming back, and that's it, everything's fixed? Of course not.
Yeah, so we're going to hone into on this week's jobs report, which has already spooked the market. As we opened up here today, the Dow was down 400 or 500 points, and S&P, everything's back down today, because now we're spooked about the jobs market, which there's been many folks that have been kind of poking holes in this argument. I've been listening to Danielle DiMartino Booth talk about how the jobs recession really started back at the end of Q3 of last year. And sure enough, here comes this revision. 800,000 and 818,000 jobs that they reported over the last year actually never existed. And they got this excuse and that excuse, and the talking head pundits put their spin on how this is still bullish somehow for the markets. But we're starting to see that weakness show. And so your take on how strong is the American economy right now? We see that the GDP still ticked back up, so there's still touting that we still got some growth, and the jobs numbers are getting revised, and it's not looking good, but they're still trying to pump us up. Your take on the jobs market, and then what you expect this week?
You know what defines a strong economy is more time to enjoy life. From that perspective, it is not a strong economy.
Well, Biden's been at the beach for the last 16 days, so maybe we should pick up from him, huh?
Yeah, well, fair enough. I wish I was at the beach. I was in Maine, trying to enjoy a little time off, and I couldn't because I'm just nonstop working on a lot of big things. But I say it's like, really, it's like you tell the person working 3 jobs, barely able to pay rent, it's a strong economy.
Yeah.
By the way, that's not a political statement. That's just a statement of fact.
Yeah.
Okay. I mean, so let's be real here. I don't know why anybody's shocked by the jobs revision. Yeah. Okay, so let's go back to the other thing I keep saying, which is also part of the whole credit event, margin call, Japan catalyst thesis. For the longest time, people have kept on saying small caps do not matter. Mm-hmm. That's like saying small businesses do not matter.
Right.
This. I mean, I don't understand. To me, it seems very obvious and logical, but it doesn't seem to resonate. People will say the market that matters is where people are indexed, which is the S&P 500 and the NASDAQ. Okay, but the majority of jobs don't come from Meta. They come from the small business side of the world. Yep. They come from small caps, which have gone nowhere, okay, for now over a year. Yep. Okay, so it's like when I keep saying small caps hold the key, I'm not trying to be cute about that terminology. They hold the key because small caps are clearly worried about credit risk. That's why they've been held back. That's why they are not performing. There is a headwind against rates when these companies, no different than Japan for the last 20 years, have been used to very cheap capital, rolling over that cheap capital, keeping their businesses alive at very low margins, profit margins.
Well, and they can't get as cheap of credit as the Magnificent Seven can.
Yeah, of course, on top of that too, right? It's like that's the irony. Those that need the credit the most have to pay the most for it. Yeah. Right? So there's a headwind there on the small cap side. What does it have to do with jobs? It has everything to do with jobs. Because if small caps are not healthy, if they're not performing strongly, isn't that also a reflection of the consumer, of the jobs market, of the domestic economy? Again, I'm not trying to say anything controversial. It just makes sense to me that, of course, jobs are not anywhere near as strong as they appear from the headlines, which keep on getting revised lower. All you need to do is look at the performance of the Russell 2000. That's your tell on jobs.
Right. Yeah, and so your prediction for this week's report, the impact that it might have on markets short term?
I mean, I don't know. I mean,
and by the way, I want to give you credit too, because not only did you get the Japan carry trade correct, you got what was going to happen after, which was the whipsaw. Which it's not. I don't know how much we're going to go up or down, but it's going to whipsaw, and you got that spot on as well.
Yeah, but it's so funny because people are not paying attention. I literally said they're going to rally. The terminology I use on X, okay, because it gets, like it or not, I curse on X because the algo likes it. It's just the truth. Anybody that knows me, has seen me present and talks to me one-on-one knows I'm as professional as it gets, but I'm playing the social media game because, like it or not, that's how you get reach, and I'm a business owner trying to also get attention. That's just a fact of you don't like it, then run your own business and see what it's like. Okay, but it's like, okay, I said they're going to rally the shit out of the market when everyone was bearish, and then people are saying, oh, you were wrong the last several weeks. The market kept on going higher. Which market, number one? And number two, I said the market would rally afterwards, because it's one thing which is remarkable about this environment is the speed with which people become overly convinced.
Yeah.
The speed with which they get overly convinced. It actually makes it very easy to become contrarian, because you can see how quickly the crowd goes from one side of the boat with the amble to another side of the boat with the amble. Right. So I appreciate you saying now on it's like when you say prediction, I always go back to it's about conditions, not predictions. But every time I hear the word prediction, I think about Clubber Lang, Mr. T from Rocky 3. It's like prediction, pain. Right? Now, I'll tell you something. Between the manufacturing data and the fact that long duration yields keep on acting risk off again, meaning you're seeing on big down dates for equities, long duration yields falling. You're seeing the return of the flight to safety, the whole Phoenix meme, which I've put out and have been wrong on, which is the flight to safety back in the treasuries. It's starting to come back again. That behavior got sparked by Japan, which is part of the thesis also. They would bring back the flight to safety dynamics in treasuries. The fact that treasury yields are still dropping tells me the jobs data probably is going to be weak.
Yeah. And so do you think, folks are locking in the yield now in anticipation of the Fed cutting rates and rates coming back down? I mean, the consensus is that they're going to be on a pace to bring them back down to a Fed funds rate of about 3.5% over the next year.
Yeah, I'm sure these are the same people that said that the Fed would stop at 3.5% in 2022.
Yeah.
It's like, for all of the screaming about the Fed needed to keep raising rates, I have interviewed 700 plus people on Lead Lag Live on my podcast, many of them entering 2022. No fixed income strategist said the Fed would go as high as they did at the start of 2022. Right. So in the same way, I would bet you the Fed is probably going to overshoot to the downside, and it's going to surprise people again. Because let's face it, for all the talk about inflationary pressure, we're in a regime change of inflationary pressure. Okay, this whole inflationary cycle has been driven by three factors post-COVID. The first shock was what? It was supply chain, right? You couldn't get shit from anywhere in the world because everything was shut down. So every single supplier started raising prices like crazy, cost push inflation. Then it metastasized into demand pull inflation because, stupidly, every single government said, we need to send stimmy checks to everybody. I was getting ridiculed in 2020, late 2020, saying, you start doing this, you're going to have massive inflation. Okay, because people are not going to go and buy basic necessities. They're going to go to Puerto Rico and take a vacation. They're going to start spending that money on porn sites, which, by the way, if you look at what happened in 2008, this is not a joke. It's actually very serious. In 2008, when stimulus checks were being put out in response to the recession back then, you can look it up. There was a substantial percentage of that went to buying porn. The people are not spending money like from the standpoint of basic necessities. They're spending it frivolously, which is what causes inflation.
Yeah.
Right?
Yeah.
Okay. So that's phase two. And then phase three of the inflation, which is what's now, I think, about to be unwound, if I'm ultimately going to be right about the reverse carry trade, is the wealth effect, the asset inflation.
Right.
Okay. Right. So three sources of inflation: supply chain initially, demand from the stimulus side, and then the stimulus from the wealth effect of both housing and stocks. If those start to break, now you don't really have inflation. Now you might have a risk of real deflation.
Right.
Deflation, which sparks a credit event. Right. Again, Japan becomes another catalyst for that, because if every deleveraging is inherently a disinflationary, deflationary force.
So basically, they corrected. I mean, this was the fastest rate that they've ever raised rates, right? And so you're suggesting that they might overcorrect to the downside now. So let's bring it back to September 18th, Fed Chair Jerome Powell. We're going to get a Fed rate cut. How big is it going to be?
I don't know. I guess it depends on what happens between now and then to global markets, right? Let's say you wake up and you suddenly have another reverse carry trade dynamic, then and it sticks this time around, then they're probably going to cut 50, 75, 100 bips if it's extreme enough, right? People forget the Fed, all the Fed does is respond.
Yeah.
The Fed is not a leader in monetary policy. The Fed follows the bond market. They're going to do whatever the hell the treasury market tells them to do.
Yeah.
It's lunacy to think that the Fed owns the bond market because of QE. No, the bond market owns the Fed. End of story. The market is controlling this, not the Fed. So if the market tells them you better lower rates, you better believe that Jerome is going to lower rates aggressively. Right? But I guess my point is that you have to have something happen first. Right? Now, there was a lot of panic around the reverse carry trade with some very notable people saying the Fed has to do an emergency rate cut of 75 basis points.
Right.
Because of Japan. When I myself have argued that Japan will serve as the scapegoat for the Fed to cut rates aggressively. And the calls were there. It was as it was starting.
I remember that. Everybody and their brother was crying.
Yeah, and it's like it's like, what happened to being a tough investor?
Yeah.
What happened to just being tough in general? It's like everyone just expects things to be handed to them, and they need to be saved by government, be saved by Powell. It's like Powell's not going to save you. You know what's going to save you? Grit. Yeah. Being able to take volatility, being able to see volatility as an opportunity to buy. That's the funny thing about all this credit event, and all these people saying you've been wrong for so long. It's like, guys, if you're a real investor, you want to see it because you want to buy low.
Right. Yeah, and well, we still got a lot to get to, so I want to keep it moving. Now, you're talking
You got me
about
fired up, man. You got me fired. You can tell. Like I've been 10 calls today. I did 2 podcasts. I'm like energized like crazy. Let's go.
you're still rocking and rolling.
Yeah, I'm trying, man.
So it's going to depend on what happens between now and then. Now, I just wanted to throw this one in there too. Do you think it's just the strangest coincidence, and it's going to be quite the show that we get to watch Donald Trump's sentencing, and not for your political take, but just what a strange coincidence, right? Donald Trump's sentencing on September 18th in New York, same day Jerome Powell is going to give us the decision.
I think we are all sentenced to ineptitude from both the political and monetary side. That is our lifelong sentence as citizens and investors. Honestly, man, it's like I am, as I get older, I get more and more cynical. It just seems like everything around us is a show.
Yeah, right.
It really does. And it's so unfortunate that that's, whether it's right or wrong, that's the feeling that I think not only I had, but I think a lot of people have. Right. That it's all this is for show, that nothing is real, nothing matters. Right. And if nothing is real, nothing matters, and how the hell can anybody possibly have an incentive to progress?
Right, right. And I think that this is why we're going to see a transition back to real value. And so one of the things that you've been saying is gold is sending a signal. You want to elaborate on what that means?
Yeah, and that's partially me playing the algo when I say gold is sending a warning, right? And I'll occasionally throw a couple F-bombs in that one occasionally.
I was going to say, I wanted to start off this interview by just asking you, very simply put, can you explain why we're so effed? Because you like to use the F-bombs.
Yeah. Well, aside from the fact it's just fact, it does. The reality is, like, the algo does like it. I have a large number of followers because of the reach, and the reach gets amplified when you have some degree of outrage. You can hate on it all you want, but that's just the truth. It's like, do you hate on the audience wanting it, or the person on the stage saying it? I mean, that's just the reality. Look, I'm not some pessimist longer term, but I will say, I think there are certain longer term trends which everybody should be disturbed by. Yeah. And I use that term very purposely, not for engagement. What are those longer term trends? The fact that nobody can hold their attention span for longer than 6 seconds, which is why Vines have been such a thing. It's why Snapchat became so big. Mm-hmm. The fact that we're constantly moving on to the next dopamine hit. If you don't think we aren't effed because of that, like the fact that the average reading comprehension in the United States is 6th grade level. Yeah. Are you kidding me?
Yeah.
Are you kidding me? And this is, you know what that means? That means the people that argue with me or argue with you, the trolls, the people that are just, maybe some of them are in your family, some of them are your friends, maybe some of them are your cousins, whatever. They probably don't even have a clue what you're saying. And time on this earth is limited. And if you don't have a basic common education level, IQ level, understanding of each other's meanings and words, you are literally wasting your life away talking to people about your point of view when they don't even know what you're talking about. Right. Like, how would you say, honest to God, it's like, how would you think that we're not effed when you kind of frame it like that, right? Doesn't mean that you can't survive and thrive. It's just, it's a sad state of affairs that this is the world that I think social media has enabled.
Yeah. I notice it in my content when I try to put out the economic data, and I joke, I try to decode the economic data to make it simple for the regular person to understand, and people don't want to hear it. They just want, what do I invest in? What do I buy next? What's the next 10x crypto? Do you have an NFT launch for me? And so speaking on that, I want to hammer in here on what happens next and what you've invested in. So on gold, your expectations and outlook for gold, if we do, let's run with the thesis that we are heading into a recession, and how do you think that plays out, and how's that going to impact gold?
Okay. So I didn't quite touch on the sort of gold is saying word. Okay, so I part of my core thing I've been consistent on this is this idea that most money is long only. So the idea that people are shorting and doing puts, like, this is such a small portion of the marketplace. The real big money that bets is betting on something that they can buy and hold for some period of time. Now, if most things are variations of beta, meaning most things basically somewhat track the S&P 500, they're moving off of the same factor. in terms of the broad market movement, most things. There aren't many true diversifiers, which are not correlated to beta. Gold happens to be one of them. So every time I've been seeing gold perform the way it's been performing and breaking out, I keep saying gold is sending a warning because for whatever reason, I believe big money has been positioning into gold. Why? Not because it's shiny, but because they have other investments and they're worried about the correlation of their portfolio. So how do you lower the correlation of your portfolio, which is all largely moving off of beta? You go into something that's not correlated, which is gold. And there aren't that many true non-correlated assets. So I think the demand for gold is being driven by some kind of cycle fear.
Right.
It's as simple as that. It's not some dramatic thing. It's literally a quantitative issue, right? From a portfolio construction perspective. Now, I remember very well 2011, 2012, the gold bugs, they were as loud as the Bitcoin maxis have been, right? Like as overconfident and this is the system save, this is what we need, everyone's wrong, hyperinflation. It's the exact same arguments, whether it was the gold bugs or the Bitcoin max, the exact same. That marked a top back then for gold. I don't see that type of dynamic now. I don't see that type of fervor in gold. I still see it with Bitcoin.
So you think gold might still have some room to run?
Oh yeah, I think there's so much. Okay, it's another interesting thing about speculation. I think it's fair to say, even though I don't have data on this, speculators, gamblers, probably on average are younger, right? And if you're younger, you probably don't like gold. You probably like crypto.
Yep.
So I don't think you have anywhere near the type of overinvestment in gold. And I keep going back to the idea that gold, listen, trends persist on skepticism. They die on conviction. So if you're going to say gold versus Bitcoin, ask yourself which trend is more likely to persist based on that statement alone.
Well, and to your point, Bitcoin has been correlated with the stock market, right, in a risk-on environment. So to move to Bitcoin, yes, folks argue that it is an alternative, but its correlation to the stock market has been very close, right? And
yeah, you're exactly right. And not to cut you off, but now I myself have also argued that I think Bitcoin will diverge if you have a credit event, because the one thing Bitcoin and gold have in common, which I agree with, is not the inflation hedge argument, not the store of value argument, is that they are counterparty hedges. That they do share that in common. Like that, I can buy that argument logically, right? So I do think
actually get away from counterparty risk.
Right, exactly. Which is what's a credit event? It's about the counterparty not paying you back.
Right.
Right. So that's what Bitcoin was birthed off of.
So Bitcoin and gold both have room to run into next year, you think?
I think more so gold, because I think the complicating factor with Bitcoin is you have ETFs which are still enabling a lot of speculative fervor.
Okay. Yep. I wanted to get your thoughts on that. As someone who has a couple ETFs and a mutual fund, what were your initial reaction to the success to start off the Bitcoin ETF experiment? It's kind of dwindled down here now, but your take on the Bitcoin ETFs and what happens next for Bitcoin?
One of the worst. This is my own personal opinion. It's one of the worst things to happen, not just to Bitcoin, but to the asset management industry. Because you know what happened with all these Bitcoin ETFs that came out? They all basically said, we're not going to charge anything on it. So they launched products which are not profitable. I need everybody to think about that for a second. It's like, as an investor, you want low fees, right?
Right.
If you were bringing a fund to market, and by the way, bringing a fund to market is very expensive. Anybody who thinks they can just do it, you need at least a 250K chip per year. So it's a very serious endeavor to be a fund manager, okay, as opposed to a basement trader, with a discretionary account on a small dollar amount. Okay, it's a very serious endeavor. So here come all these.
Call me out like that, Michael, but it's okay.
No, man, you're good. I like your pet hamster. It's okay. No. So, but the point I'm saying here is that it's like you got to be careful what you wish for. Right? I've seen, you probably know this much better than I do, so I'd pick your brain on this too. I've seen some suggest that much of the AUM that's gone into the Bitcoin ETFs, has largely come from Bitcoin itself, meaning it's not new fiat.
Yeah,
it's just people that want the convenience.
Well, look at the grayscale to BlackRock shift, right? It's very simple. Yeah, that was money that already had been allocated towards Bitcoin through the Grayscale Trust, which got converted to an ETF, which couldn't compete with BlackRock's ETF. Right. So BlackRock has these big, massive numbers that hit all these headlines, And I've talked about this since January when we topped. I warned that that was going to be the top, and it was. We topped out at 49,000, then we crashed down to 38.5. We got slaughtered after the ETF got introduced. But I'll let you finish your comments on that.
No, and again, you know this obviously much better than I do. So I it's well known academically, very well known, that the moment that you put any investment into a tradable basket, the volatility and correlation change, right? So you can see that in studies around, let's call them small cap stocks that grow substantially, and then suddenly they get included in an index like the S&P 500. Suddenly the correlation to the S&P 500 is much higher, even though the beta should be based on the company fundamental, not based on the school of fish and how it's moving. Mm-hmm. It's a similar dynamic when it comes to anything that's brought into an ETF wrapper. That was once not a part of that universe. It increases the co-movement, which makes it not really what it should be, which is a true alternative asset.
Right.
On average.
Yeah. And so Wall Street's arrived, and it's been funny to see this shift. Like you said earlier with JP Morgan, they talked about it being a pet rock and only used for criminal activity until they have an ETF product to, offer. Then they turn bullish. But I wanted to get you. So you're saying, there's less fees to be made. It's not good for the industry. But do you think that there's more of an appetite? We see that the Ethereum ETF came. There's rumors of Solana. Your thoughts on additional appetite for more ETFs? And then your thoughts on the SEC. I find this interesting. Gary Gensler and the SEC won't come out and say whether or not they think Ethereum is a security or not, but they went ahead and approved the ETF. So your thoughts on additional ETFs and the SEC's regulation?
Look, I mean, I think as a general rule, regulators are influenced by lobbyists that pay for politicians to get in office, who then put the regulators in place. Yep. So from that perspective, none of that to me seems like a surprise. Right. And that goes beyond the SEC, that goes to the FDA, that goes to any regulatory body that is put into place by politicians who are put into place by companies that are basically paying for their campaigns. Yep. This is it's an indirect form of influence.
I call it the bureaucracy beast.
Yeah, it's just, and I think people would be foolish to think otherwise, right? Yeah. So, look, I am all for free markets in the sense of, bring any kind of product out into a fund and let the market figure it out. Mm-hmm. Where I think it becomes problematic is if you are enabling self-destructive behavior, right? And if you're enabling self-destructive behavior by allowing products to be out there which are either extraordinarily leveraged, right, or are based on some trick in terms of the way total return is calculated, I don't know. I just don't think it's good for society. But then again, I'm not on DraftKings, but it seems like you can bet on literally everything on DraftKings.
Right.
Yeah, we are all.
Yeah, no, I agree 100%. And so on additional ETFs, do you think that they are kind of inevitable? I think that there's going to be a big success in basket ETFs, which gives you exposure to like Bitcoin, Ethereum, and a couple others, right? Your thoughts on that?
Yeah. Okay, so again, I go back to, and we were just talking about this a little bit earlier, and I'd like to pick your brain on this too. I think there's a lot of validity to the idea of crypto / Bitcoin. I know people separate out the two, but that as an asset class, which means, it's probably not a bad idea to index it, right, and create a basket. To your point, the thing is, in the crypto space, there's far more equivalent pink sheet stocks than in the public stock market, meaning in the same way that you have a lot of these kind of fraudulent, very micro cap type of companies that come out, and like that story of that, what was it? Some deli restaurant that suddenly had a valuation of $100 million, right? That this is like back in 2020, it was based out in Jersey, I think it was. You have much more of that type of dynamic in the crypto space because it's so easy to just come up with code and change it up and make a crypto out of it. But I think if there's thoughtful construction, it makes total sense. Why not?
Yeah. What about yourself? You have any interest in crypto? Any investments in crypto you can speak of?
My store of value is my health.
There you go.
So I do not. I have said very publicly before, I'm not against owning Bitcoin. I think actually it makes sense because I go back to what's the purest definition of the market. Purest definition of the market is all investable assets, not stocks, or not just stocks. It's everything. So if Bitcoin is an investable asset and other Ethereum and others, then sure, they should be part of a market portfolio. But you got to just weight it appropriately. There's nothing wrong with that. I take issue with narratives like store of value, inflation hedge, because it makes it seem like these investments are safe.
Yeah.
And if these investments are safe, guess what that does? It causes leverage, which causes crashes, which causes them to not be stores of value.
Right. Have you, and I got to ask you, because my audience, we're big into XRP, which is one of the assets in this digital asset space, right? And then you got a company called Ripple. I don't know how much you know about them, but I just wanted to ask you, have you ever heard of Ripple? Have you looked into them? This is a company that's private right now, and they're building out the XRP Ledger ecosystem. Any thoughts on that project and company?
Only on the periphery. I mean, I'm not as immersed in this, and candidly, I've been so in my own world from a trying to build my own business standpoint. I don't know much about it other than what I see randomly on X/Twitter. What I would say is, it's like any other general advice, right? Don't put all your eggs in one basket. This is the thing which is tricky about whether it's investing in any single crypto or any single stock. I was at a conference many years ago, and I forget the guy's name, but the guy said something along the lines of, diversification is a luxury for the rich. Which actually, if you think about it, is a very well said and accurate statement. Diversification is a luxury for the rich. The implication there is what? If you want to get wealthy, you have to take a concentrated bet.
Right.
But the problem with a concentrated bet is that you can also go broke. Right. So I only say that in the context of XRP, in terms of Ripple, only just from the standpoint of no matter what investment, no matter what your belief is, how much you own of something matters more than what you own.
Yeah. Right. Yeah. And I think that you have a lot of folks that are in the crypto space. And I think, to your point, they're looking at Warren Buffett. They're looking at these big hedge fund managers. They're looking at folks like yourself, which have to deploy a lot more capital than the little guy who needs to, invest his $5,000. And it's a completely different strategy, right? There's a reason why Warren, the Oracle of Omaha, is in 280 billion cash or whatever that amount is, versus what we're doing here is a little bit different. But I wanted to speak on your fund here as we close off this session here, which has been an absolute pleasure, Michael. Thank you so much. So for those who don't know, you have one mutual fund, 2 ETFs. I took a look at your mutual fund, and it's invested in bonds, ETFs that are mostly focused on bonds. Could you explain the strategies behind these and in what environment you anticipate these could do well?
Yeah, and to be clear, by the way, it's a good. I'm glad you mentioned that. The ETF structure, you have to disclose the holdings daily, which are available on atacfunds.com. Mutual funds have their own disclosure requirements. Looks like the SEC actually or FINRA now has shortened it up to month as opposed to a quarterly. So those holdings are probably out of date.
But I think it was May actually.
Yeah,
so I probably am late.
Yeah, it's fine. But okay, so broadly speaking, okay, I'm gonna talk from the standpoint of the industry. Vanguard and BlackRock have a lock. Right, and it's like it's no different than the app world where like 99% of people's time are spent on just 5 apps. Every other single app is vying for that 1% of attention. Right. Same thing in the mutual fund and ETF world. BlackRock, Vanguard have the lock. Every other issuer is vying for the smallest percentage possible of attention in terms of assets. Okay, now I go back to what I said earlier. Most things are a variation of beta. So if you're going to be in the business of fund management, you have to create a product which is different to stand out, that Vanguard and BlackRock will not play in, right? Which means you have to create something which has some shiny object potential, where it stands out in a really big way, right? Now, of course, if you're going to develop a fund that can stand out in a really big way, the implication there is it can stand out in a really big way positively or a really big way negatively.
I was going to say, just launch a crypto ETF.
right. So in the case of my mutual fund and ETFs, they're all variations of the same concept: risk on, risk off. Leading indicators of volatility, where they have a commonality, is not in the signals that determine risk on or risk off, but rather in the fact that when they play defense, they are in long duration treasuries. So if you're familiar with an ETF like TLT, For good reason. That's how I designed the funds, rules-based, meaning they'd run the exact same way if I died tomorrow. Those funds need to be in treasuries by prospectus, which tells you why I've been so cranky the last 3 years, where we have just gone through the most unbelievably largest dislocation in long duration treasuries in history.
Right.
Something that's generational. Okay. In what happened, especially in 2022, where in my case, my funds launched into that and had to be in treasuries during that period. So you look at the performance of my funds, they don't really look that great. You look at the indices behind Roro and Jojo, you'll understand why I launched the funds. You'll understand why the last 3 years are an anomaly. You look at my mutual fund, ATACX, you'll see how it did in 2020. It was up 72%. It had the shiny object because there was a volatility. And that goes back to how we started the conversation. I am biased. I want to see volatility because I want to see risk-off behavior in my funds.
Right.
I want to have a chance, unlike what's happened the last 3 years. We'll see. But all I know is that it's as is probably the same feeling that a lot of the crypto players have now. Things are never quite as easy as you think it will be, and things will always take longer than you think they will.
Yeah. Well said. I mean, in our particular case, we battled the SEC for almost 4 years now in this Ripple versus SEC case, which is set to finally conclude. We're waiting for the appeal window to close up, and then we're like finally done. But I can understand the sentiment there. But what I respected about you the most, Michael, is that you've stuck to your thesis, not just because you want to be loud on X, but because you have real convictions and you've stuck to that. It's based off of data and fundamentals. And so I really do appreciate, your analysis, everything that you bring on X. I'm going to link up all your stuff down below. You are the publisher of Lead Leg Report. I see you have a Substack. We're going to get you linked up. You got YouTube, you got X. Is there anywhere else that I should mention?
No, it's Substack and X and Threads, Instagram, Lead Lag Live, and I gotta have you on the show at some point too, so I can learn a little bit more about XRP and Ripple.
Yeah, it'd be my pleasure. Yeah, so once again, folks, all the links will be down below. I appreciate you coming on, Michael. Look forward to having future conversations and keep up the great work, brother.
I appreciate it. Thank you.
All right. Thank you, everyone. We'll see you guys in the next episode. I am your host, Zach Rector. I really appreciate all of the love and support. If you want to support the channel, just remember that you can start by smashing that thumbs up for me, sharing this content far and wide, and everything else is at my website.